All right, just a few of the stories that we are tracking. But for investors, there's a lot of bigger picture questions right now, such as what's going to happen on interest rates, what's happening with the debt ceiling, and of course, the earnings picture giving us at least a snapshot on how companies are faring through all of this. Quincy Krosby tracking it all. She's Chief Global Strategist at LPL Financial. Great to see you. Thanks very much for your time. So I guess, what is the most common question you're getting from investors these days, just given all these headlines?
It's all of the above.
Yeah, exactly.
It is the debt ceiling. Yeah. It is where's the Fed headed? Because it really does affect everyone's lives. Small business owners in the U.S., consumers, where are rates headed? And that's very important for on the granular level.
And it's really interesting because every country is sort of on the same path, but at different stages. Yeah. Here in Canada, the Bank of Canada had gone in pause mode, but some think, well, maybe they have to raise rates. But it seemed like today, Jay Powell was trying to prepare the markets for at least a pause point here. I guess there is this concern the higher rates go. What are the ramifications from that?
Well, exactly. And, you know, you saw the market actually pick up as he was speaking, because all week we've had Fed speak nonstop. And it has been, you know, what is he saying? What is she saying? And it's been mixed. So market was waiting for him in this morning's talk that he gave. And he says, look, we have stress in the credit markets. That may give us what we need in order to bring down the inflation to the level that we want. But we're watching it. And he didn't rule out a rate hike in June. I mean, it's June 14th is the day. There's a lot of time to go. But I can tell you this. When he was speaking, the probability of a rate hike, Fed funds futures market went way down. And adding to that was the walkout of the Republican negotiators in the meeting. And then that pushed the probability down even more because the Fed's not going to raise rates if there's an issue with the debt ceiling.
I mean, there's so many moving parts. Yeah. And to your point about what's actually happening in the credit market, because the subject of regional banks also came up again today. You know, Janet Yellen suggesting maybe there will have to be more deal activity. We'll see what happens. But the lenders themselves are increasingly cautious. And so that itself almost has like a tightening effect on the economy? Well,
yeah, of course it does. Because if I can't get a loan, for example, to buy a vehicle, although Americans have been buying vehicles based on the last report. But let's say I go in and they say, Quincy, sorry about that. It's going to be much higher. I may pull back. You get enough of us to pull back, it's going to slow the economy. And that is what they're looking at, the effect of that. Mind you, we haven't seen it yet, but they think normally that's what would happen.
So, Quincy, against that backdrop, what generally has been your advice to investors?
Well, we have been looking at the fixed income market, which is back. It's offering attractive rates, whether we're looking at U.S. treasuries or investment grade, more short duration, of course. But you're getting very good returns. So that can be added to a portfolio. The other thing is we've been looking at preferred stocks. Preferreds sometimes make people nervous. But the fact is, because of the issues in the regional bank market, the returns are much higher. We're not suggesting going to the regionals, by the way, but looking at preferreds in the money center banks, which are under much more regulatory scrutiny than the regionals at this point. And they are offering attractive rates, too. So those are the preferreds. In terms of equities, in terms of equities, we're looking at industrials. They have been holding up. And if we do go into a recession, they have a history, statistically, of coming out of a recession with the industrials moving higher. They've been underpinned by defense spending in the U.S., but around the world, and also infrastructure spending, which is ongoing. And so we expect that to continue. We loved oil. I noticed you were talking about the crude prices marching higher. They have been bottoming. Companies are delivering shareholder value. But we've pulled back a bit from that. We want to see where this is headed in terms of the energy consortium.
Yeah, it's
complex.
obviously at least the daily swings impacted by all of the headlines.
Yeah.
And just to wrap things up, because this seems like a theme I'm hearing from a lot of strategists right now, to look for those areas where there's something reliable. And you mentioned with industrials, I mean, defense spending is not going away, depending on how many more interest rate moves we see or what happens. Well, I guess technically the debt ceiling could impact that, but probably not.
Well, exactly. Yeah. But I'll tell you, and you know this, the U.S. market is very short of breath. It is big tech, mega tech. Those are responsible for most of the moves in the market. If we took them out of the equation, the S&P 500 would be flat for the year. With them in the equation, the S&P 500 is up, NASDAQ is up. We need to see a broader market. It's a healthy market. It's not to negate the attraction to big tech. There is a major attraction, but we need, for ongoing viability in the markets, we need to see more sectors leading the market higher.